Big question asked by so many people around the globe, specifically here in the United States. Why is it the United States has such a high break even cost for producing the oil that we produce? Well, let's be realistic. We're a very, very free enterprise country. Everybody who has any type of asset has the right to go to the market and find out what it's worth. Unlike most countries who produce oil around the globe, all those reserves, all those mineral rights, all those reserves that are in the ground that are being harvested are owned by the government. They're harvested by the government. They may allow companies to be created like in Russia. They may allow companies to be created like in China. But those companies and those management teams and all those assets are ultimately controlled by the government themselves. So if that's true, what causes the U.S. to have such a high level of break-even cost to produce a barrel of oil? It's simple. If I'm a landowner and I have mineral rights, I want as high of cost I can charge to make that oil company pay me for the right and the opportunity to harvest the oil and gas underneath my ground, underneath the mineral rights that I own. So I'm going to compete and I'm going to cause competition between different oil companies that want to lease my minerals, pay me a high cost, and give me a percentage of royalty income when I make that contract or that lease agreement. That's one cost. What's the second cost? The leasehold itself. I may have to spend $5,000, $10,000, $20,000 an acre to go lease property, and I have a huge capital outlay. Well, that huge capital outlay means I'm paying the cost of capital. It's either shareholders want dividends, the banks want interest payments, bondholders want bond payments and interest payments on those bonds. There's a holding cost and the cost of capital, not even factoring in the ultimate calibration of risk. What's the risk of those leases not being any good? What's the risk of putting money in the wrong spot? Then you start adding in all the other components that go to the U.S. oil and gas exploration, all privately owned companies. We're talking from cattle guards to tanks to fencing to chemicals to drill pipe to drilling fluid to location, pad site creation, dozer costs, water. All those costs are all put into the equation by a free market. If oil prices skyrocket, the guy supplying diesel goes up on the price of diesel. He charges a diesel surcharge for every truck that comes on the property. If chemicals go up because petroleum goes up and the chemicals used in drilling are also a negative effect because of rising oil prices, the cost of drilling goes up. Today, I can drill a well for $8.5 million and maybe it takes me $180,000 to break even at $70 oil. Oil goes to $100 a barrel, that break even drops by 60, 70,000 barrels per well of recovered oil to break even to pay my money back. The reason why the United States is always going to be one of the highest cost producers of oil in the world is because we effectively have so many free markets that have their fingers in the pie. Free markets do work. Unfortunately, because we are a free market, every single party in the food chain in the United States oil and gas industry is making a profit. When we finally get the oil and gas produced from the well that we drill, now we got to get it to market. Well, the guy that's laying the gathering line from the well to the transmission line says, well, I got to charge you a gathering fee. That's 15 cents per 1,000 cubic feet, and it's 35 cents a barrel. And then that barrel is going to go in the next line. Well, they're going to charge 50 cents to get the barrel from gathering to transmission to the next line. Along that midstream, along that pipeline passageway, the producer's probably going to lose somewhere between, 35 cents up to $2 or $3 a barrel just in cost to get it to market. That's not the problem in other countries. They own the pipelines, they own the refineries, they own the equipment. It's all factored into their numbers. One of the other things you got to keep in mind is that we have all kinds of taxes that are owed. We have all kinds of ad valorem taxes, state taxes, production taxes, which means we're losing anywhere from 5 to 9% for every barrel produced. We're losing that in taxes that go to the state in which we're withdrawing that oil and gas. That's not taken out in other foreign countries because they're getting the whole pie anyway. So what you have is you have a totally different economic regime when it comes to U.S. production versus virtually any other producer in the world. It's a free enterprise. The price of free enterprise means you don't get to use the government control and policies to manipulate the price of your commodity unless you happen to own it all, and then you don't care. So let's say Iran today is a $10 to $12 a barrel break-even price. However, in that country, they also need the extra money from that barrel to support their country because that's pretty much all they have to offer, for the most part, is crude oil sales. That's what keeps them alive. Same thing happens with Saudi Arabia and Kuwait and all the other countries that produce oil. They have to use the revenue from their wells and their production to run their countries. We run our country off of taxes and income taxes and state taxes and sales taxes and property taxes. So we run our country on taxes and debt. They run their country off of oil sales. So I would say a production comparison of the cost of a break-even barrel of oil produced, we're the highest. But I'd say a functionality cost of a barrel of oil, some of those countries that can physically produce a barrel of oil for $10, $11, $15 a barrel, they need $70, $80, $100 a barrel when they factor in running their entire economy off the sale of that barrel of oil. U.S. is different. We need, as an independent industry, the oil and gas industry, we need prices probably north of $65 a barrel to break even and justify the risk and the cost of capital. We really don't in today's market. I mean, you might break even if you're Exxon because you own the refineries, the pipeline, the processing, et cetera. You have downstream distribution. You might be able to break even at $40 to $45 a barrel. But if you're an independent company or you don't own refineries and you don't own all the pipelines, you are getting skimmed off probably $5, $10, $15 a barrel before it ever gets to market between taxes and midstream and cost and refining and processing. So you start looking at the market and you say, I've got to have at least $65 to $75 a barrel, thin margins just to break even, to justify drilling the wells I'm drilling. What does that do to the global market? Well, the U.S. is the largest consumer of oil on the planet. We're about 21 million barrels a day. We're also the largest producer at about 13.7 million barrels a day. We still have a shortfall. That comes in terms of natural gas liquids. It comes in the form of crude oil, condensate, or we have to import it. So regardless of what we do, we still need about 7-8 million barrels imported a day more than we produce from inside the country. That still leaves us a $65 to $75 price we have to have in terms of producing oil and gas in this country. When you start to see the dynamics change between break even and you start looking at what it means in deploying capital and risk, you start getting south of $60 a barrel like President Trump wants. He wants oil below $55 a barrel. Oil companies are not stupid. We're not dumb in the industry. We simply lay down rigs. We lay off crews. We delay completing wells. We stop putting new wells out to be drilled and developed. We say, we're just going to produce what we have. And somewhere in that curve, the lack of paying us what is fair price or break even with profit to justify the cost of capital, the risk, and a reasonable rate of return, you're going to see a diminishment in the outbound supply side because we're going to drill less wells and produce them slower. And then that pendulum swings the other way. That brings oil price back up again. So if you look over the last 30 or 40 years, starting in 1985 when I started my career, oil prices were running $9 to $11 a barrel. Then it went to the next regime, $25, $30 a barrel. Then it went from $35 to $50 a barrel. And then all of a sudden it was $75 to $90 a barrel. And in between all that were spikes high and low. Today, I'm going to argue with you, and I'm going to say that the next decade is going to bring oil prices at a normal standard without political intervention in regulatory environments or what I call a geopolitical risk like the war in Russia or the war in Iran. You're probably looking at oil being somewhere between $75 and $90 a barrel. Now, there's a lot of rhetoric out there about supply is going to save the world. All these other producers are going to save the world. Let me tell you why it's not. All those oil supplies coming online the last 4 months, all the oil looking to rush to the market, were not economical at $65 to $70 a barrel. They all drilled and got active, hoping oil would be $90+ a barrel. So when this whole geopolitical risk shakes itself out, Iranian war, Straits of Hormuz, all this shakes out, the world's going to find out that you only have so much oil that can be produced at less than $70 a barrel, and it won't be enough. The oil appetite in the globe is ferocious. The appetite's growing. The users are growing. The consumer is not cutting back. No one's going on an oil diet. That means what? Long-term oil price will have to be north of $75 a barrel to keep an equilibrium between all costs from all producers across the globe, including the countries who produce or drill wells with $11, $15, $20 a barrel break even. Their cost to run their country is going to go up, which means they have to get more for the oil they sell because the revenue from the oil they sell takes care of the supply and the economics of running their country. Thanks for listening.